Welcome all. Coleman Report Live. Lance Sexton is out of the house. So we've replaced him with Chuck Evans and Scott Evans. You guys related?
Brother from another mother.
Yes.
No relation.
My dad.
No relation.
Scott Evans, co-founder, Government Loan Solutions, the experts in the secondary market. Chuck Evans, president of Capital Growth Solutions, one of the better loan service providers out there. How's that, Chuck? Is that a fair assessment?
That's awesome, Bob. Thank you so much.
Hey, Scott, I want to talk with you. We're going to go to polls first. I should read the script. What percentage of your SBA 7A loan portfolio do you sell to the secondary market? Scott, what is the answer to this? What percentage of the loans get sold?
Boy, I think we're probably in that 40 to 60 bucket. Bob.
Well, we'll see.
What folks aren't selling right now. Oh, I couldn't have been more
well, of course, our audience, our audience is all over the board, and we tend to have a little bit smaller banks, or lenders, I should say. I love the 10% all, but it's all over the board. Anyway,
Now remember,
Go ahead.
It's 75% or greater. That's that red flag with the Paris score.
Well, you are, okay, you're technically correct.
Yes.
It does not negatively impact your Paris score, as Brent
That's
Chimino
correct.
told.
That's correct.
But it's a red flag. If you're selling everything to the secondary market, SBA just says, okay, what's going on? It doesn't mean you shouldn't do it. It
Absolutely.
just means you may have a little bit more added scrutiny.
That's
ahead,
my
Chuck.
call for today.
All right, well, very good. What's going on with the secondary market, Scott?
Well, I'm going to give you a take on this. It's probably a little different than my poll response, which was the conservative, take the middle of the road approach, and pretty candid about it. So the secondary market, if you look at it from an outsider's perspective right now, it's very stable. Prepays, yeah, they're up from where we were a couple years ago, rising slightly. No alarms going off. Prices have been exceptionally stable, maybe rising slightly, especially in the last 6 months or so. So it would look like to the outsider all is well. And I would say to a degree that's true. But the biggest thing that I would say probably to any secondary market participant is kind of keep your ear to the rail. Make sure you know what's going on, because I personally feel, and I think the street would agree with this, that there's a tremendous amount of vulnerability right now to the secondary market. A couple things to note. One, you look at volume as kind of some indicator, because our market really is not as a technical trading market as much as it's a supply and demand driven liquidity market. Pool volume looks about like it did look last year.
I have no idea what you just said.
To explain it, what I mean is that, when you trade futures, let's say, guys are looking at charts and figuring out what the next price move ought to be. Our market doesn't trade like that. It doesn't have the opportunity to short the market or some of the kind of components that you see in more traditional markets. So ours is driven purely by supply and demand. Well, largely by supply and demand.
Right.
That's where things get weird. So supply in terms of pools looks about like last year. Again, no bells, whistles, red flags. However, loans, that's a totally different story. What we hear anecdotally is the pipelines look good. But since the shutdown in December, I would say loan volumes 60% of what it was last year, all else equal at this time. What that means, and this is one of the reasons prices have stayed so stable, is it means that inventories are exceptionally low for the dealer community. It means they're carrying.
And they need to buy. They need to buy this stuff.
They do.
Did the rate decrease in the beginning of this month affect the market?
Not at all. Now the talk is, of course, that we could see 50 to 75 before the end of the year. That would affect this market. I'm sure of it. Our market is overpriced, in my opinion, right now, especially the equipment end, so the 10-year stuff. To me, I think we're kind of poised for a bit of a pullback. It's just a question of what's going to be the driver of that. There's obviously political risk out there, which is creating flight to quality into bonds. I mean, we've seen that in the Treasury market as well. Our market, as people search for yield in the fixed income space, our yields still look okay. Relative to SBA, it doesn't look that great, but relative to other stuff, we're still okay there.
Scott, got to ask you the question. I know you're going to dodge it. So, I'm the CFO of the lender, and I'm putting together my budget for 2020. What number do I use? Do I keep it the same? Do I hedge a little bit? Do I increase it? What do you think?
if it was me, and I'm a conservative guy when it comes to this stuff, I would budget for lower numbers. I would budget down a point or two. I would say if we're trading, I'd say we're 2 points lower. All else.
Really?
I think we can be. One of the things that the market, the typical secondary guy doesn't see, whether you're on the lender or even dealer side sometimes, is what happens in the IO space. It's a very vague space. It's very illiquid, and it's been very much responsible for supporting some of the pricing we're seeing.
You're not calling this dark money, are you?
It's not dark money, but there ain't a lot of it. Let's put it that way. So
I just, full transparency here.
Hey, you know what? I've got nothing to lose in that game, so I'm fair. I'm okay to tell the story as it is, but that's the risk, I think. When you've only got a couple guys that are supporting higher prices, you've got some political risk out there, the potential for lower rates. I think all those things add up. And if we start to see some supply creep into the market, which we're starting, I think, in the last 2 months to see some of that come back, and if dealers start to build some inventory and therefore risk on their books, then I think we very likely could pull back. And I think there's much more downside than upside potential at this point.
Thank you for that honest assessment. Yeah. And I always ask the question, we don't know what the future is, but I always love to put you on the spot. Hey, you and I co-founded this conference back in 2008.
That's crazy, right?
Yeah. I mean, we were there when Lehman went bankrupt. There was no secondary market. I remember the UN was in town and people were jumping off us. Anyway, tell us about the 12th annual secondary market.
Yeah, crazy enough, here it comes. So this early December the 10th this year, we do have the conference. I would definitely encourage anybody that wants to attend to get in early. There's a discount for doing so. I think it's a little under $1,000. So get your registration. And it has been not only a well-attended conference, but it's a little more meat on the bones kind of conference. We talked, I talked briefly here a little bit about the secondary market, but I'm but one piece. We'll get into that a little bit more detail at the conference. We also bring in experts in USDA 504, folks from the SBA. And
well, tell about that. I mean, SBA, and I'm personally appreciative of that. They bring their staff, their secondary market experts, John Wade,
right,
and his staff, and they're very blunt about what's happening. And so and this is the only conference out there that specializes one full day. And there's other events that'll give an hour in the secondary market, but we spend a full day there. Who was our keynote speaker last year?
Why you put me on the spot with that? I can't remember. I was probably working during that time because after I speak, I go back to the computer.
No, we had Senator Risch, head of the
small business. We had a senator in, and he was fantastic, actually. One thing I like about not only just the keynote speaker, but all the speakers is it's a very interactive conference.
Yes.
So it's not one where people are talking.
These are a bunch of type A personalities.
Yeah, participatory. So be prepared to do so if you come. And that's one thing that I think makes it different than others.
Marty Techler's office, Blank Rome, is a partner in this, and we have it at his office. And if this is not of interest to you, I would strongly, if you're in the secondary market, get your CFO there. I mean, that's what I do. Hey, Scott, I always appreciate your insights. Thank you very much.
Thanks for having me, Bob.
Good to see you, Scott.
Okay, let's go to the second poll question. My source for calculating cash flow will be, and when I say my source, I'm talking about what do you as a lender do to calculate cash flow for SBA? I did a webinar yesterday on calculating global cash flow, and just curious. Chuck, what is best practice? Is that it?
Tax returns.
Yeah, but you can do. But
yeah,
the point
all the above, Bob. Right.
The tax returns the point of this poll question is SBA does not tell you what to use, and they don't tell you to do 3-year average of tax returns or to the last year or financial statements or whatever. But what they do tell you is to be a prudent lender is to be consistent, right, Chuck?
Yeah, absolutely correct, Bob.
Very good. If the company is an established business, SBA says cash flow should be calculated with the what? This is sort of a redundant question, but it's an important takeaway point we want to emphasize. And the SOP doesn't answer the question, correct, Chuck?
Correct. You have your 4506s with your tax returns. You got to have those. So all of the
I would
above.
strongly encourage you, because one of the first things SBA is going to ask you on your review is what is your separate SBA lending policy? And Chuck, I think it would be, well, it has to be prudent to say, hey, we're going to calculate cash flow based on tax returns, financial statements, whatever. I don't think you're going to be criticized whatever you choose, as long as you put
You're
it
consistent.
in writing and stick to it and be consistent.
Yes, absolutely.
Very good. Very good. All right,
Questions?
Chuck, you're on the hot seat. How does SBA
Okay.
treat non-recourse debt in a
Well,
cash flow calculation?
In my humble opinion, it would be no different than any other debt. If you're looking at financing it, the purpose has to be for an SBA eligible purpose, but it's the same as any other debt.
Very good. We got a bunch of questions, so we're going to fire through.
Go.
How do you feel about, this is the what they call the lightning round. How do you feel about underwriting where the bank does a bank adjusted projections column when the borrower has projections that seem high and the underwriter doesn't like it? The underwriter says, I'm going to add a separate column and put down what I think is appropriate.
Two points here. You can sensitize the projections. That's good underwriting. But if you have a borrower that comes in and provides projections that you feel or your underwriter feels is outrageous, I question the borrower's management ability or his ability to project the business. We've seen some high-flying projections, and when you sensitize them, it still works out. But the question still comes up, is the borrower realistic or not?
I have two comments. Number one, we've seen the last 2 weeks, we've had these Inspector General recommendation of denial of guarantees because of faulty projections.
Yes.
Because that's it's a Monday morning quarterback first of all. What I would do, my recommendation is if you have a borrower who has that you believe are unrealistic projections, I'd send them to your local SBDC. That's what they're.
Absolutely. That question came up once before, and the banker asked, what do we do if we don't like the projections? Don't make the loan.
I would send them to the SBDC.
Absolutely. Absolutely. I agree.
Yeah. But I agree with you. I wouldn't make the loan because you're going to get stuck with that guarantee when the Inspector General says, hey.
Yep.
All right. Should all affiliates be included in global cash flow?
Yes. Period.
Number 4. But let's make life simple. You get to decide who an affiliate is.
Yes.
An affiliate is control. So
yes.
Our recommendation is go through the personal tax return, see every source of income, and determine. One of the reports came out that there was a denial of a healthcare company that the Inspector General determined that they had control of a company in Japan, of a hospital in Japan. And so I think you need to go through and say, we don't think this is an affiliate, and why. And this is a one sentence type thing. Again, yes. Where you get in trouble is where you ignore it. If you address it, I think you're going to get a pass because you recognize and you say, no, we don't think it's an affiliate, and these are the reasons.
That's okay. That's the narrative, but certainly you got to look at all of them.
Chuck, what is the minimum acceptable SBPS score?
That's a loaded question. The minimum SBPS score is 140. But if you look at your portfolio and you have your Paris review, if you have an average score of less than 180, you get a 5 on there, which is not the best. If your average score is between 180 and I think it's 200, you're average. It's a 3 on your Paris score, and over 200, it's a 1.
Chuck, what are you telling your clients that they should do as a minimum?
Well, you should review this on a quarterly basis to see what kind of trends that you have as to making loans, because this is a very good predictor as to performance. So if you start seeing a portfolio of 150, 160, I'd start to worry. Now, community advantage is a different animal.
An SBA is going to be looking very
yes.
close. Yeah.
It's a portfolio management tool.
Okay. What do you think? What is your recommendation for the chief lending officer for that minimum score? Not minimum. I misspoke. Average score.
Well, it should run from 180 to 200.
Fair enough.
Absolutely.
Okay. All right. If an owner has multiple Schedule E businesses, would you request historic tax returns? These, I believe, are for real estate investments. The answer is you got to get all this information. And
Absolutely. No shortcuts. No shortcuts.
Because you want to know what the global cash flow is. You explained the need to subtract the owner's draw from operating cash flow. I'm confused by that. If the owner isn't there anymore, we have a business acquisition. How can we add back the previous owner's compensation and then do an add back assuming the new acquirer has a lower compensation? Can we do that?
Yeah, if you're going to add back that which was unrealistic for whatever reason, and then you deduct whatever the current owner's salary or expenses are, that makes sense to me.
And that makes sense to SBA. I would just go back and get the acquiring owner's tax returns to make sure.
Yes.
If they're saying 75,000 and they made, they're living off 50,000 a year for the previous 3 years, that's reasonable. Again, what Chuck and I are saying is go ahead and explain it. Yep. I have what SBA gets upset about and the regulators is when you don't explain your thinking. We understand that underwriting is more of a art than a science, and they want to understand what your thinking is. And as long as you explain it,
9 times out of 10, you'll be okay.
Yeah. The last question, I have a business that needs working capital. Total will be $150,000. The issue on this is that $64,000 is going to be used to pay an outside contractor for a loan she did to build some custom products. There's no documentation. What do we do?
Well, a couple things. Is the $150,000 permanent working capital supported by the business and its operations? Is it reasonable? Number one. Number two, it says it's a loan. It could be treated as an accounts payable.
Thank you.
That's where you look at that. So if your operating cycle supports this, you're fine.
Yeah, and again, 1 or 2 sentences. Very good, Chuck. I want to introduce Katie Watucky. She's our new contributing editor. Katie, come on in. Thank you for joining us.
Hi. Thank you for having me today.
We'll be kind. Chuck, say hello.
Hello, Katie. Welcome.
We're going to start a new, Katie, you graduated from University of Utah, living in Southern California. Welcome. So you've been with us, 2 months?
Just about, yeah.
Yeah, and you're doing great work, so it's good to have you. We're going to be kind. But one of the things we're going to start doing, Chuck, is one of our most popular products is Fraud Friday. So we're going to come out with something. We haven't quite figured out. We're going to call it Fraud Daily, whatever. But there's so much content out there. One of the first things Katie did was talking about the Nick Fattel fraud. This guy, we've had frauds in our industry, bank serve, but the frauds were misrepresentation of documentation and taking shortcuts. This guy went fully beyond that. He did $180 million worth of loans and made everything up. Made up addresses. It was horrible. And a lot of people got hurt. He sold these to pension funds, to retirees in the Midwest, and it was all fabricated. He then took the money. Do we have a slide on that, Joseph, on what he did with the money? Is that the next one? He took the money, bought a $5 million house in Orlando. He custom jewelry, I think, Katie, a Lamborghini and a Rolls Royce, 7 Rolex watches. Anyway, so they let him out on bail. And he said, you know what, guys, let me out on bail, and then I'll help you recover the money. Well, after he gets out of bail, he does 2 more fraudulent loans. Anyway, Katie, I want you to tell us the story of what happened at the Orlando Executive Airport.
Yeah, so as Bob was just saying, he got out on bail, free bail, that he convinced the court that he was going to help pay back all of these people that he had defrauded. And then at 7 a.m., just a couple days before Patel's sentencing, he tried to get out. An FBI agent followed him, found him he was headed toward the international airport. When he approached Patel at the airport, he found $40,000. He had spent $40,000 to charter a flight to Ecuador where he was trying to seek political asylum. And when the agent arrested him, like you said, he seized 7 luxury watches. He had $20,000 worth of cash on him, numerous credit cards, and a white powder. It turns out he had
powder. We're not saying what that is.
I don't know what it was. Turns out he had obtained a fake passport, wired $3 million to Ecuador.
Passport from India, correct?
Right. Yes, he had a friend do it for him. He had $500,000 worth of luxury vehicles already waiting for him in Ecuador, and as you said, he had rented a $1 million house.
And the judge did not take kindly to that. They transported him to Chicago via diesel therapy, and he actually went to Oklahoma City. And Katie, do you want to talk about diesel therapy? What they do to these poor inmates?
Right. So what they do is they'll put them on a bus or a plane, and they'll just drive them out for hours, sometimes days. They have limited access to food, limited access to the bathroom, and it gets very exhausting, and it's just very difficult for them.
And you don't know where you're going. They're not going to tell you anything. And the wardens coordinate this to, okay, I'm going to, it's a fantasy football trading thing. I'm going to send you 5 and you send me 5. But anyway, I checked on this, and they sent him through Oklahoma City to Chicago, and he was in Chicago. We don't know how he got to South Carolina. Anyway, Katie, thank you so much for your reporting. Thank you for joining us.
Thank you.
Well, very good. We got some, these are the upcoming events we always like to push. And hope I'm going to be, obviously, we have the Secondary Market Summit. I encourage you, if you're interested in doing rural lending, I encourage you to show up in Washington, D.C. We tried to do this back-to-back. Unfortunately, that didn't work out. And we have some upcoming webinars. Please take advantage of. Lance Sexton is doing the 5 critical C's of SBA lending. Importantly, the new character rules, credit elsewhere. I'm going to do one on USDA B&I lending. And this is a free webinar on using 401ks. It's what we call a sponsored webinar. DRD sponsors that. And Susie Granger is going to tell you how to use someone's 401k to correctly document SBA's equity injection. And Chuck, with that, we're 23 minutes after the hour. We respect your time. Send us your questions. We'll talk to you next week. Thanks very much, Chuck.
Take care.